Audi dealerships look like glass palaces for the wealthy. Behind the polished floors, something else is happening. This is not just a car showroom. It's a financial machine most people never see. Every Audi parked outside is part of a bigger game, a game built on debt, margins, and manufacturer control. Owning an Audi dealership sounds like an easy path to riches. The reality is far more complicated than it looks. That's the story we're breaking down today. Some Audi dealers quietly earn millions every year. Others struggle just to keep the lights on. So what actually separates the winners from the strugglers? To understand that, you have to follow the money. Audi carries a prestige few car brands can match. The four rings symbolize German engineering and status. That badge alone pulls high-income buyers through the door. Wealthy customers don't just buy cars, they buy identity. Identity buyers rarely negotiate hard on price. This is exactly why investors chase Audi franchises. A single Audi dealership can move hundreds of vehicles a year. Each vehicle can carry a sticker price over $60,000. Multiply that by monthly sales, and revenue numbers look enormous. On paper, it looks like a guaranteed cash machine. A busy service department can push profit potential even higher. Luxury buyers return for maintenance instead of doing it themselves. That loyalty creates years of recurring income per customer. This is the dream that pulls investors toward the Audi badge. Some investors don't stop at one dealership. They dream of owning an entire regional empire, multiple Audi locations under one owner spread across a state. That's where the phrase dealership empire actually comes from. But dreams and balance sheets are very different things. Getting approved to sell Audi is not simple. Audi doesn't hand out franchises to just anyone. Only a small percentage of applicants ever make it through approval. Applicants need strong capital reserves before they even apply. Audi typically requires proof of significant liquid net worth. In many regions, that means several $million up front. Some regions demand even higher reserve requirements than others. Then comes the real estate requirement. Audi demands prime, high-visibility locations for its showrooms. That land alone can cost millions in major metro areas. Next comes the building itself. Audi enforces strict architectural standards called Audi terminal design. Glass facades, specific lighting, and premium finishes are mandatory. A single compliant showroom can cost $2 to $5 million. In competitive markets, that figure can climb even higher. Then there's inventory. New Audi dealers must stock dozens of vehicles up front. A modest new car inventory alone can exceed $2 million. Most of that inventory is not paid for in cash. It's financed through something called floor plan financing. That means borrowing money just to have cars sitting on the lot. Every day those cars sit unsold. Interest keeps accumulating. Add specialized diagnostic tools and required staff training costs. Altogether, total entry cost can reach $8 to $12 million, and that number exists before a single car is sold. This is why Audi dealerships are rarely owned by individuals. Most are owned by large dealer groups with deep pockets. Small independent operators are slowly being priced out entirely. Territory rights add another layer of complexity. Audi grants exclusive selling rights within a defined radius. That protects existing dealers, but also limits future expansion. Losing that exclusivity can quietly shrink a dealership's value. Once the doors open, the real business begins. New car sales look like the obvious moneymaker, but new car margins in luxury retail are surprisingly thin. On many Audi models, dealer margin sits around 3 to 6%. That's before incentives, marketing costs, or discounts are applied. Buyers now compare prices online before they even visit. That transparency squeezes margins even further. So how do dealers still make money on new cars? The answer is something called holdback. Holdback is a hidden percentage Audi returns to dealers later. It's not visible on the sticker, but it matters a lot. Dealers also earn manufacturer incentives for hitting sales targets. Hit your quota and Audi quietly pays you back. Miss it, and that extra profit disappears completely. Even holdback percentages vary based on sales volume performance. Then there's the finance and insurance office. This is often the most profitable room in the building. Financing a car through the dealer can generate hidden markup. Extended warranties and service packages add even more margin. A single finance sale can add over $1,000 profit. Multiply that across hundreds of monthly sales. Suddenly, the finance office looks like a quiet profit engine. Used car sales add another layer of income. Trade-ins bought low can be resold at strong margins. Certified pre-owned Audis carry premium pricing and higher buyer trust. But the real profit center is the service department. This is where Audi dealerships quietly print consistent money. Audi owners pay premium labor rates for maintenance. Specialized German engineering requires specialized, expensive service tools. That complexity actually benefits the dealership financially. Independent mechanics often can't service certain Audi systems properly. That pushes loyal owners back to the dealership for repairs. Service labor margins can reach 50 to 70%. Parts sales carry similarly strong markup percentages. A steady stream of oil changes, brakes, and repairs adds up fast. Unlike new car sales, service income is stable and predictable. This is the quiet backbone of dealership profitability. Successful owners eventually stop thinking one store at a time. They start building small empires across a region. A second location spreads fixed costs over more sales. A third location increases buying power with lenders. More locations mean stronger leverage during manufacturer negotiations. This is how modest single dealers turn into wealthy groups. Some of the largest auto retail groups now trade on public markets. Private equity has increasingly moved into dealership consolidation too. They see steady cash flow and buy up smaller dealer groups. That consolidation trend is quietly reshaping who owns these franchises. Empire building sounds glamorous, but it multiplies risk just as fast. More locations mean more debt, more staff, and more exposure, but every stream of income comes with a matching expense. Floor plan interest is the first silent drain. Borrowing millions just to stock inventory isn't free. Even at moderate interest rates, that adds up fast every month. Unsold inventory sitting too long quietly eats into profit. Then there's mandatory facility maintenance. Audi requires dealers to keep showrooms at brand standard. That means periodic remodels, sometimes every 7 to 10 years. Those remodels can cost hundreds of thousands of dollars. Skip the remodel, and Audi can penalize the dealership. Marketing co-op requirements add another recurring cost. Dealers must contribute to regional Audi advertising campaigns. That's money spent whether or not it drives local sales. Staffing costs are heavier than most people assume. Certified Audi technicians require ongoing manufacturer training programs. Skilled technicians expect higher wages than average mechanics. Sales staff need deep product knowledge for luxury buyers. Insurance on high-value inventory is another significant expense. A lot filled with $60,000 and $80,000 cars carries real risk. Property insurance, liability insurance, and inventory insurance all stack up. Utilities alone for a large glass showroom aren't cheap either. Heating and cooling massive glass buildings costs real money. Add security systems needed to protect expensive inventory overnight. All of this operates before a single sale even closes. This is why revenue numbers can be misleading from the outside. Big revenue does not always mean big profit. So why do some Audi dealers still struggle badly? The first reason is allocation control. Audi decides which dealers get the most desirable models. High-demand vehicles like RS models are tightly rationed. Dealers with weak sales history often get fewer allocations. Fewer hot cars mean fewer walk-in buyers and less momentum. The second reason is the shift toward electric vehicles. Audi is pushing hard into electric models like the e-tron lineup. EVs require expensive charging infrastructure at every dealership. They also need different service training and specialized tools. EVs have fewer moving parts, meaning less service revenue over time. That directly threatens the dealership's most profitable department. The third risk is a shift toward the agency sales model. In parts of Europe, Audi has tested direct-to-consumer pricing control. Under that model, dealers earn a smaller flat commission instead. That structure can eliminate a dealer's biggest profit lever entirely. Some analysts believe this model could spread to more markets soon. The fourth risk is regional oversupply. Too many Audi dealerships in one region split limited buyers. That drives price wars between neighboring dealerships. Price wars quietly destroy already thin new car margins. The fifth risk is economic sensitivity. Luxury car sales drop fast during economic downturns. When budgets tighten, luxury purchases get delayed first. Service revenue can soften too, as owners delay expensive repairs. The sixth risk is franchise termination language buried in the contract. Underperform for too long and Audi can pull the franchise. Years of investment can disappear with one contract decision. This is the part most new investors never fully consider. They see the 4 rings and imagine guaranteed prestige profit. They don't see the manufacturer holding most of the real power. So is owning an Audi dealership actually a good business? The honest answer is, it depends heavily on execution. Location matters more than most people expect. A dealership in a wealthy metro area behaves differently than one on a quiet highway. Operator skill matters just as much as location. A well-run service department can outweigh a slow sales month. Scale matters too. Large dealer groups can absorb costs small operators simply cannot. They negotiate better financing rates and better allocation deals. Independent single-location owners face a much harder uphill climb. For the right operator in the right market, profits can be strong. For the wrong operator, losses can pile up quietly for years. This isn't a business you casually stumble into. It's a capital-intensive, manufacturer-controlled, high-stakes operation. Prestige is real, but so is the pressure behind it. Behind every polished showroom is a tightly calculated financial machine. Margins are thinner than they look on new cars. Profit is hiding in service bays, finance offices, and holdback checks. Costs are heavier than most outsiders ever imagine. The manufacturer, not the owner, holds most of the real control. That's the real story behind the Audi dealership empire. Not guaranteed riches, but a complex, high-risk, high-reward machine. One that rewards patience, capital, and operational discipline above everything else. Ultimately, the four rings guarantee prestige, not profit.